We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. Let's talk about gold, the fundamentals, and Wyckoff talk. Fundamental 1. Open interest on gold is huge. Here's the GLD. Scroll down to here. There's the open interest. Open interest has a relationship with turning points. Nothing moves in a straight line, therefore you suspect there's some sort of correction coming. But everybody is long gold, or they expect higher prices in gold. Swaps are loading up, commercials are loading up, specs are loading up. The swaps have a larger position in 2016. The commercials have a larger position in 2016, and the specs are nearly getting their larger position in 2016. But much more importantly, the shorts are collapsed, so they're expecting higher prices. But the large open interest suggests there's some sort of correction coming. First chance for correction, or first chance for supply to come in, is around on the GLD 148. Or on the futures about 1600. Okay. Let's talk some fundamentals. Fundamental 2. This is the gold price going back a long time, the 70s. Let's talk real interest rates. A real interest rate is where you take the interest rate and you deduct inflation. If you have money, you are supposed to earn interest above inflation to prove that your money has not been deflated away by the cost of inflation getting higher. When you have a situation where real interest rates are negative, that is when inflation is higher than your interest rate. Your money, that's your deposits, your fiat currency, has been deflated away. Thus your purchasing power has been reduced. And those with money want to hedge themselves against such occurrence, they buy something which does not deflate away. They buy gold or silver. And when the period gets extreme, they load up on it and it moves rather quickly. As you can see here, a period of negative real interest rates, a period of negative real interest rates with the odd pop, and it's actually turning down at the moment. So gold does well in negative real interest rates. I think for the first time ever, as I understand it, let's just say since the 70s, or even the Great Depression, we now have negative interest rates in Europe, Japan. So that's the fundamentals here were, quite frankly, real interest rates were going negative. So what happened here? The fundamentals suggested that price should have continued like this. So what happened there? What happened was that the momentum and all the money getting into gold was getting carried away. Banks are worried about their deposits and people getting the money into gold. The stock market was worried about the money going from the stock market, and all brokers have been asked, I want to buy some gold. And I think the Europeans pretty much begged the US government to do something about the gold price. And my belief is that, from my research, is that I think it's commonly known on the web, 33,000 naked shorts were pumped into the market to push price down here. 33,000. And as there was not 33,000 longs on the other side, price went down. I understand that the Commodity Exchange Commission rules are that only one single person could do 3,000, one single entity can do 3,000 naked shorts at a time. Well, what actually happened here, we had 33,000 naked shorts within 2 or 3 seconds, and it pumped the market down. And obviously the only person who could do that was the US government, because it's legal for them to do that under national security rules. But as you can see, the fundamentals were fine for a rise in gold price. But as the market was spooked as a government footprint, it took some time to recover. but allowed a massive accumulation. The new fundamental here is that, which obviously I think it's a little bit harder for the government to reverse, or even anybody to do anything about it, because the demand coming into the gold market now is just going to be too great, is obviously the negative interest rates. So not only is fiat currency losing value on real interest rates because inflation is greater than interest rate. Now I'm talking about US inflation. I'm comparing the US 3 months interest rate and US inflation. And that's the growing market of negative bond yields. That's when you've got $100,000 in the bank and interest rate is -1, and every year they deduct $1,000 out of your account. That's one fundamental that I don't think anybody is going to be able to undo with negative interest, with a naked shorts. So we've got two fundamental factors: negative real interest rates and negative interest savings. Well, negative interest rate bonds obviously accelerates negative real interest rates, especially in Europe. Now we just have a look at the Wyckoff. Here we have GLD. We had our sudden climax, volume down there. It allowed us to form a range. We had our bear trap, where springs were formed and volume tests were formed. We had our minor sign of strength up to here, didn't break out. We had our pullback, a terminal shakeout pretty much because it was smashed down. Terminal shakeout is to really bust the weak hands. It's a sharp, fast move. That's what we had. We had more accumulation going on here. This is base. People knew, big money knew that the game was changed. This period here set the alarm bells for those who invest in gold or those who are short gold. They realised that the negative sovereign bond market was a game changer. So in this particular area they reversed their positions, shorts got out, long started the build. We had a fade here. Okay, they didn't want the market to break out too quickly. And now people have got very aggressive in this downswing. This downswing here was the longs building up positions. They want to build up positions at a lower cost average, so they sell the market down, sell 10 million to buy 15, sell 10 million to buy 15 million. Okay, and once they got the low down there, obviously that's when all the divergences happen. From this point on, gold has moved up faster than the stock market. That means there's a real bias now for the gold. What I expect, or what everybody should expect, quite frankly, resistance attracts supply. Oops. Not clicking right. Resistance attracts supply, so you have resistance up here. We've got high open interest. There's no reason why we shouldn't expect some sort of consolidation or even a pullback down there. Okay, to where the breakout is, and then I expect higher prices over a period of time. So if you're not in the gold market, you might have a chance to enter. Let's have a look at the monthly chart. Scroll down to the monthly chart. Here's the monthly chart. Now look at our breakouts here. We've got base pattern here, breakout, pullback. Bit of a base pattern here, but the really good move, breakout, pullback. Obviously a much larger one here. That was the 2009. Whoops, back to front. And here's the base pattern here, breakout, pullback. Okay, so you pretty regular. So I'd expect some sort of action like this here. Most likely this one here has gone up, and probably a pullback to 130, 1320, 1325, 1350. Pull back here, hold above resistance, support, sorry. Here's the old buttons. Here we go. And that's people, what actually happens in this point here, typical Wyckoff talkers, that those who are wrong adjust their positions and get long, and those who are long only a little bit get long a lot more. Now what would be bad in the sense of for the bulls is that the volume builds up here, and there's actually this consolidation that we expect may be used to build up shorts. So we have to watch how the volume builds, and over a period of time we should have high volume at the beginning, then volume subside, and then price advance. Yeah, obviously if I'm a bit earlier to talk about my consolidation, I can still go to 1600 on the GLD and then consolidate. Okay, so timing is going to be a thing, but I believe the consolidation is coming as history does repeat, but the levels we just have to wait and see. Gold is in a bullish move because two fundamentals are very, very strong. Open interest suggests that there's a pullback coming. At what level is to be decided. The Wyckoff pattern here is pretty damn gorgeous. There's nothing wrong with it. It's actually brilliant. So I think there's people calling for a gold bull market. That is true. But we need one final test to confirm at the next consolidation that those who are wrong are going to get long, and those who are long are going to get long a lot more. Now, even if a US dollar breakout does happen, gold could hold the consolidation in this area a little bit longer. Thanks for watching.